Should I invest in stocks or property? It's one of the longest running debates in investing. And after analysing years of data across both property and shares, I found something surprising. The asset that performs best on paper isn't necessarily the one that will make you more money. So in this video, I'm going to break down how property and stocks have actually performed over time and which one is more likely to make you the most money in 2025 and beyond. But before we get into the numbers, there's something important we need to clear up. When you ask yourself the typical question, should I buy property or investing in stocks, you're not comparing apples with apples because they aren't just two different ways to invest. They are completely different types of assets. One is hands-on, the other is passive. One is easy to buy and sell. The other can take months. And when it comes to volatility, well, let's just say that they don't move in the same way. But for this video, we're not here to debate all of that. We're going to compare apples with apples and answer the question, which one makes more money? So let's take a proper look at how these two stack up. Imagine we're back in the year 2000 and two friends, James and Sarah, each have £100,000 to invest. Sarah decides to put her money into a global stock index. James, on the other hand, uses his £100,000 to cover the deposit and costs of buying a £300,000 property with a 75% mortgage. Now, let's fast forward 25 years and take a look at what happened. Sarah's investment grew by 7.65% per year, and her £100,000 is now worth £631,000, whereas James's property, assuming he achieved exactly the average UK return according to Nationwide, only grew by 5% per year, which doesn't sound as impressive, especially given that he'll have spent more time on it, even if he used a managing agent. And on paper, you'd be right. Over 25 years, stocks outperformed property, 7.65% versus 5%. And even if we go back further and look over the course of 145 years, it's the same story. Shares grew by 6.83% above inflation, while property managed 5.44%. Plus, Sarah had the added advantage of keeping her stocks in ISAs and SIPs, meaning she paid less tax. But here's what people don't see with property. Although his investment only grew by 5% per year, because James used a mortgage, aka leverage, his £300,000 property is now worth just over £1 million. Take away the £200,000 mortgage and his equity alone sits at £815,000. That's nearly £200,000 more than Sarah ended up with. And we haven't even counted his 25 years of rental profit, whereas we did include Sarah's dividends. And this is what most people forget in this debate. Property is the only investment where the bank will lend you 3 times your money to buy more of it. It's standard practice to buy property with a 75% loan. Now, could Sarah have borrowed money to buy more shares? Technically, yes, but because stocks jump up and down so much, it would have been an incredibly risky move. And this is what makes the property versus stocks debate so tricky. When people say stocks perform better than property, they're not wrong. They're just missing a crucial piece of the puzzle. But the thing is, we're not investing 25 years ago. We're investing today, and that changes everything. A big argument against property right now is that the US stock market has been on fire. Over the last 25 years, it's grown by an average of 9.3% per year. Just last year alone, it shot up by 22%. Even if you factor in leverage, over the last few years, US stocks would still have come out ahead. So why wouldn't you just invest in that? Well, the argument against doing that is precisely because stocks have done so well. Let me explain. A huge driver of returns is the price you're buying in at. The more expensive an asset is when you buy it, the lower your future returns are likely to be. One way to measure this is by looking at how much an asset costs relative to the income it produces. With stocks, that's called the price to earnings ratio, which is how much you're paying for the stock per pound of profit. And when stocks are priced high using this measure, future returns are usually disappointing. In fact, historically, when investors have bought into the US stock market, the S&P 500, at today's valuation levels, the returns over the next 10 years have been near zero or even negative. This means that if Sarah takes her £100,000 today and invests in the S&P 500, she could be facing a decade of little to no growth, or worse, losses. But what about property? Isn't that overpriced too? Well, the best comparison to the stock market's price to earnings ratio is property's price to rent ratio, which is how many years of rent you need to collect to match the price you paid. Now, The problem here is that finding reliable rental data is tricky. The ONS only goes back to 2016, and the best data that I could find starts from 2008. But let's work with what we've got. In 2008, the price to rent ratio was 24, meaning that if James had bought a property then, he would have needed 24 years of full rent without any costs just to break even. Bear in mind that this was at the peak of the boom just before the financial crash. In 2012, after 4 years of prices falling, the ratio dropped to 20, meaning that property had become relatively cheaper compared to its income. Looking back, this would have been a great time to buy. Moving forward to 2022, after the COVID boom, the ratio climbed back up to 21.4, meaning property was getting more expensive again. But today, if we take the ONS average UK rent, which is £1,329 per month, and the Land Registry's average UK house price, which is £289,000, the price to rent ratio comes out at 17.59%. So that means if James invested today, he'd need just under 18 years of full rent to match what he paid for the property. That's far better than previous market peaks, better than the low of 2012, and even better than at any point since we have reliable rental data. So what does this tell us? Well, this method isn't perfect, but it gives us a good idea of where things stand. Property isn't an absolute bargain right now, but contrary to popular belief, it's not overpriced, by this measure at least. Meanwhile, the US stock market does look historically expensive, and someone investing today should keep that in mind. However, when it comes to whether property or stocks will make you more money, there's one more important thing to consider. We've seen that stocks tend to beat property, but using leverage changes that. And we've also seen that because stocks have done spectacularly well over recent years, while property has struggled, property might do relatively better from here on. But none of this factors in potentially the biggest obstacle to making money with any investment: yourself. I know plenty of investors who panicked during the 2020 COVID crash, sold all their stock at rock bottom prices, and then didn't have the confidence to buy back in until prices were much higher. Whereas selling a house is a massive hassle. You can't panic and hit a button to offload it in seconds. There's no live price ticker, meaning you feel sick when value dips. I even saw loads of people in 2022 freaking out because their US stocks were down 13%, even though the year before they were up by 39%. With property, you don't see these swings. You don't even know what your property is worth on any given day. And that, in my opinion, gives property an edge over stocks for some investors, because the biggest risk to your returns isn't the market. It's you. That's why the best investment isn't just about what makes the most money on paper. It's about what you'll actually stick with for the long haul without making any stupid decisions. Because over the long term, it doesn't particularly matter which you choose. You'll do well with either investment. The most important thing is to stay in the game. That is what really makes you money. However, if you're leaning towards property after watching this, there are a few crucial things you need to understand before you put any money down. So check out this video next, where I break down everything you need to know before you invest in property.